Hey everyone, Lyft reported fiscal 2023 first quarter earnings results that sent the stock crashing. Lyft stock price is down 21% following this announcement. So I wanted to go through these earnings results and share them with you and answer if this stock price decrease was justified or if this is a buying opportunity for those of you interested in Lyft stock. So let's begin. So revenue increased by 14% to 1 billion. The net loss improved to 187.6 million from 196.9 million year over year. However, the loss from operations worsened to 216.7 million. That was up from 199.3 million. So between the loss from operations and net loss, there is an other income line item, most likely that was interest income. Lyft has a lot of cash on its balance sheet, and as interest rates increased, Lyft, I think, has been able to earn a higher interest return on that cash on the balance sheet, and that's what caused the difference between the loss from operations worsening and the net loss improving, if that makes sense. Okay, because you have the operating loss, and then you have some line items like other income and other expense before you have the net loss item. And so between those is where you had the interest income. And interest income, the reason why that is not as impressive as operating income is because that can change with changing interest rates, right? Right now, interest rates are high, but interest rates might lower in the future, and so the company can't generate that much interest income. You would like a company to generate most of its profit as operating profit because that's where it holds a competitive advantage. That's what it's in the business of doing, offering rides. So that little difference to me is a big deal because it shows me the core business is not as strong as might appear if you just look at the net loss, right? And so revenue increased by 14%, but the company generated a bigger loss from operations. So they weren't able to demonstrate economies in scale in the quarter. As a result, I think looking at the poorer results, management made decisions to cut costs. And here's a quote directly from management saying, "We've moved decisively to cut our operating costs, and will use the savings to pay for continued service level improvements near term." So they did cut costs, and they're going to try and improve on their effectiveness, their efficiency in the near term. Active riders increased by 9.8% to 19.55 million. That was solid, although the increase wasn't as much as expected. Remember, this time last year, the US economy was just, gaining momentum in reopening, right? This was right when it was, really booming and things were starting to get back to pre-pandemic levels. But this year, it's really the momentum has continued, so you would expect more people taking rides than before because people are spending more time and money doing things away from home. Revenue per active rider only increased by 4% to $51.17. That was a disappointment. The cash flow from operations did show very nice improvement to negative 74 million. This was up from a negative 152 million in the prior year. And the management is forecasting second quarter revenue of 1 billion. So sequentially flat year over year, again probably similar growth to the previous year. Now, in and of itself, the quarter, I mean, it wasn't a horrible quarter looking at it just by itself. It wasn't a great quarter. No demonstration of economies in scale, revenue growing, and your operating losses worsened. So that wasn't impressive. And then the revenue per active rider only going up by 4% is also not impressive, right? But what made Lyft's report look even worse is if you compare it to Uber's. I'm going to shift to Uber's report here real quick. If you remember, I did a video on Uber's earnings, and if you look at just its mobility segment, because Uber has Uber Eats and the rides business, right? So I'm just going to compare it to its mobility business, which is the rides business. The gross booking value increased by 22%. Uh, uh, the take rate increased by 28.9%. Mobility gross booking value increased by 43%. Overall, net revenue for Uber in the quarter increased by 29%. The bulk of that growth was from its rides business, right? Because its delivery business only grew by 12%. The rides business grew by 43% compared to Lyft, where its rides business only grew by 14%. So a significantly lower growth rate for Lyft compared to Uber if you just compare ride segment to ride segment. And then they're not delivering the kind of um, improvement that Uber is. If you look at loss from operations for Uber, it improved to negative 262 million from negative 482 million. So the loss improved, whereas with Lyft, the loss from operations worsened to 217 million from 199 million. So in and of itself, I would say Lyft had a neutral to below average quarter. Um, Closer to below average, I would say. And then comparing to Uber, it makes it look that much worse because the industry consumer demand was robust in the quarter, but Lyft wasn't able to capitalize on that. So to answer the question, yes, that stock price decrease following the earnings is justified, and no, I don't think it's a buying opportunity in Lyft stock. All right, that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.